Happy Wednesday. It's the middle of the week, and it's always the middle the hump day, as it's called. We're getting close to that weekend, and hopefully the week's been active and we've been trading good and making some money. Today we've got a little bit of data coming out, some housing. Pretty much I'm kind of ignoring all housing data right now. I think it's all going to be good, and I think anything that's bad is already priced in the market, so I don't really think that it's something we're going to focus on. But somebody did write in and really wanted to understand, how to understand overbought and oversold market conditions. And I think that's something that needs to be understood, and I think it's a great question. And just to remind everybody, please feel free to email me. I will cover anything. I will answer any question live here. There's nothing I won't answer that has to do with the markets. Let me put that the right way. Anything that has to do with the markets, I will answer. Okay? Anything. And I will try to explain it in a way that everybody can understand it. But looking at markets, so how do you know a market's overbought or oversold? Well, there's a ton of different indicators, which I don't use, but there are these stochastics, okay, which will show you spots. If they get all the way down to the bottom or all the way up to the top, those are typically overbought or oversold conditions. And you can use slow or fast, and they're always based on the time frame that you are trading. Because the markets, if you're trading a 1 or 2 minute chart, overbought or oversold conditions happen there as well. Okay? Now, most of us are always used to what's the long-term chart, which is what I'm always referring to here, is what is the overall longer view. So you can use the relative strength index. The Bollinger Bands are probably the best overall indicator for overbought or oversold conditions. And really, if you understand the Bollinger Bands, or if you don't understand it, the Bollinger Bands are 3 lines going through. The top line is 1 standard or 2 standard deviations above the mean, which is the average price. The bottom line is 1 or 2 standard deviations below, depending on how you have your Bollinger Band set up. So typically, overbought would be when we get through the upper band, because anytime a market moves a couple of standard deviations against, we figure that we're going to have some sort of selling pressure. And anytime a market goes standard deviations below, we figure to have some buying. Now, this is obviously, nothing is automatic, and the market doesn't have to have a time when it's going to sell off. But recognizing that we are getting into those positions, okay, and in the condition of overbought or oversold, like for example, if you look at last week, 5 up days in a row, that's typically coming into an overbought position. Okay, the week before, 5 down days in a row, that's an oversold condition. Now, it doesn't work. It doesn't have to mean it's the 6th day that is going to be the day that's going to turn around. It could be the 3rd day. It really depends on volume and how fast they get to where they're going. But the general rule of thumb is the more days you consecutively knock in a row, either up or down, the more likelihood you are coming to an overbought or an oversold condition. Okay, the bigger the move, the faster it happens. Usually means you're getting too far away. Because if you notice, most markets, when they're trending solidly, will move in a 45-degree angle, somewhat like this. When they go like this, or they go like this, typically they're overbought or oversold. I hope that helps everybody. I hope that answered all your questions for Wednesday. Remember, Bubba's Picks still on fire. Have a great day. We'll talk to you on Thursday.